Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Hermes Fraser Lundie to talk about inflation. Hello, Fraser.
Hi.
So I don't want to sound like a broken record because last time you sat on that chair, we talked about US Treasury bonds, but they are yet again quite an interesting concept because there are increasing concerns about inflation from some parts of the market and the impact this will have on the Fed and the Fed's decisions and the impact that will go on to have on the wider bond market. So I suppose the first question is, are you concerned about inflation?
Well, as a credit guy, we're always concerned about everything. But I would say that the signals being given by the Treasury market right now are to some extent conflicting with what you see in other markets, particularly on the equity sides. You've got the Fed's intending on raising rates several times in the next couple of years, and yet the long end of Treasury curves are telling you a different story with regards to long-term confidence in the economy and some potential signals about the importance of stability around the dollar. And you've seen certainly in the last few weeks in particular what a bit of dollar strength, and I do say a bit because we're not far away from unchanged on the year now, has done to the sentiment in the emerging market credit space. So it really does underpin everything, which is why people like me are glued to inflation all day long.
And when you say you're glued to inflation, are there particular flags that you're looking for, like, for example, the US jobs figures we've had recently?
Yes, and we're also very focused right now on the oil market and other spot commodities. We have big news this evening, one way or the other, from Trump, I think, with regards to Iran, and that is fueling potential inflation via the commodity market, but it's also fueling added geopolitical risk. And I think that is what is keeping us in this new volatility regime that we're in since that volatility shock in the first quarter. It now seems that we are not returning back to those very low levels for the foreseeable future. And again, we need to price that in from a credit perspective.
And so we are in this new environment, as you suggest. We are in an environment where the Fed is making the raises that it suggests it will this year, and volatility has returned. So how do you, as a credit investor, reflect that in your portfolio?
Well, I think there's a lot of discussion around how late cycle we are or not in the market right now. And I think that within credit, it's difficult to say that we are very late cycle because of the sectoral makeup of the market. It tends to be a mixture of very cyclical sectors, a lot of whom nearly died a couple of years ago in the energy crisis. And then a lot of things that arguably are being disrupted right now. So healthcare, autos, telecom. None of these sectors to me seem particularly late cycle. In fact, if anything, they are behaving quite defensively. That's a very different market to what's going on in equities, which is very tech driven and therefore quite shareholder friendly. So from that perspective, I think you're likely to get more attractive risk-adjusted return than you might expect from cyclical credit today than maybe in previous cycles. Having said that, covenant weakness is an issue for us, and I think that it has changed the risk-rewards profile of low-quality credit. Essentially, if you're going to get it wrong now, because of the optionality being held so tightly by the sponsors or indeed the companies, the lien that you'll have on assets, or in fact the assets in the box when it really comes down to a default situation, is likely to be a lot lower in terms of recovery than you've seen in previous cycles. And at the same time, convexity in the market right now remains pretty unattractive given how short call prices are. So I think it's hard to argue that it's a sensible time in the market to be reaching down in credit quality, but I'm more than happy to take a more pro-cyclical approach because of the ideas I mentioned earlier. The other thing that makes me quite constructive right now is that we are still in a search for yield environment because ultimately yields are pretty low, especially at the front end of curves. And so I think there's a lot to be said for making sure that you're optimizing what point in the curve you're accessing credit at, because a lot of people seem to be dipping their toe half in and they don't really want to be there, which is understandable because things are relatively expensive here, as all markets are. But if you are able to access credit longer out the curve without necessarily taking an undue amount of interest rate risk, I think that's where the real opportunity is, because it's kind of under-owned, and the roll-down contribution to your carry is significant here because curves are so steep. So I would say that lending for longer to better quality companies rather than shorter to lower quality should be a mantra for this year.
Fraser, thank you very much.
Thank you.
This is Emma Wolf from Morningstar. Thank you for watching.